there are 3 points that I want to make over here, which is basically diversified versus focused portfolio, or in general also, right? Sanjay sir also kind of referred to this thing, which is basically about timing the market versus trying to time the market. What will a diversified portfolio always try to do? He'll try to slightly have a higher churn. He'll try to get in and out of positions. Majburi hai, kuch kar nahi sakte, because sectors like oil and gas, sectors like, for example, utilities, capital goods, right? You'll have to have a higher churn. You'll need to time metals, mining. You'll need to time them perfectly well. If you hold a metal stock for 10 years time frame versus you keep getting in and out of positions accurately, believe me, you'll make more return by getting in and out of position. But the problem with that is that nobody that I know of, including one of the best fund managers in the mutual fund industry, stalwarts, nobody has ever been able to time the market perfectly, ever in life. 2 times out of 10 that you'll go wrong, it's game over, it's zero-sum game. And that's why we always say that it's about trying to spend as much time in the market. Sanjay sir showed it very beautifully. I am doing it more verbally. But the fact that it does not matter where the market is. If the goal is to go from 100 to 1000, it does not matter whether your journey is starting at 95 or 105. What matters is how smooth is the path. What matters is how good is the business that you are investing in. And that's why it's always about investing in a business, never in a stock. Second thing, which is majority of the wealth creators globally, okay? You look at Raamdeo ji, you look at, Warren Buffett, even somebody like Rakesh Jhunjhunwala, a majority of their wealth was created by very few stocks. You can count the number of stocks on your fingers. At one point of time, I remember when Sanjay and I used to work with Raamdeo ji together in Motilal Oswal, their entire wealth was invested in just one stock. One, Hero Honda. And that's what I used to do with him. Work on just one stock. Day in and day out. Hero Honda. Right? You look at the amount of wealth that Rakesh Jhunjhunwala has created in Titan. One stock. And measure the percentage of his wealth that has been created because of Titan. And you'll get the answer. Right? It's not about trading. It's not about getting in and out of positions. That's not what equities are meant for. Equity markets are meant for creating wealth and not generating income. Equity markets are meant for multiplying your money, and that's why you take the risk of equity, right? Otherwise, you might as well invest in debt. आज तो 7.5%, 10% double A rated paper में आपको debt में भी मिल जाएगा. Then what's the point of doing equity? Equity is about doubling your money every 4 years, and if you're not doing that, there's no point at all. The longer you stay, the more wealth you create for yourself, right? And that's the message I was trying to leave you guys with, which is basically de-risk yourself away from sectors that you do not understand, because equities fundamentally is like going back to school. You have to learn and you have to keep relearning every single day, right? If you ask people who have been in this industry for 30, 35, 40 years, they're discovering new things even right now. It's like an ocean. So stay away from sectors if you don't understand them. Don't try to get into metals, mining, utility if you're not able to understand them. There's always going to be a sectoral exposure risk. And don't try to time the market. The best example is look at the stock like Reliance. Okay, we don't have Reliance in our fund, obviously. So when 2020 came, between May, June, right up till October, November, we underperformed massively. Why? Because we did not have Reliance, and Reliance went from 800 to 2,100 bucks, and everybody came back. In 1 month, I remember we had an underperformance of about 6 percentage points to the index, which in a PMS business can kill you. People came back and said, you're not buying Reliance, you're not buying Reliance. I said, you look at the last 7 years return for Reliance. You look at what happened to Reliance from 2015 to 2020, and you look at what has happened to Reliance from 2021 to 2023. Look at the time frame of 10 years. What is the CAGR of return in Reliance that you've made? That'll give you an answer. So don't try to time the market. If you would have gotten into Reliance a little late at 1,400, 1,500 bucks, you'd still be sitting here and crying today saying that yaar kuch hua hi nahi, everybody else made so much money in Reliance, I didn't. So it's always better about investing in businesses and not stocks. That's the message I wanted to leave you guys with. Thank you so much for